Thank you for being here. We're going to give you, or they're going to give you, their thoughts about where the economy is now. And we'll look at quite a few themes. There's a lot going on. I should say first, I'm Philippa Thomas, moderating, and I think you know who's on the panel, but Oliver, Pippa, Bill, Ross, and Adrian will all be giving us their thoughts, and I'll also be inviting questions when we get a little way through the discussion, so that if there's anything you want to say, the lights are kind of in our eyes, so if you do feel strongly about something, make sure you kind of get your hand up when I ask. But thank you very much, and in fact, I want to begin just by a thought about the way we introduced this session, because I think the introduction says the US economy, let's see, buoyed by employment gains and declining energy prices, continues to advance. And I want to ask our panelists, would you describe the US economy as buoyant? If you had to pick a word, what would you use? And take a minute or so just to give us your idea of where the US economy is right now. And I'm going to ask Pippa to begin.
So I think there are two economies in the United States. I come from Washington, D.C., and I grew up spending summers in L.A. We've always thought there are two Americas. There's the coastline and the interior. And we see this now in that we have one economy that's absolutely on fire. Chief executives say they cannot find enough skilled workers to employ. They are hiring 18-year-olds directly out of high schools, going back to the old GE 1950s model. Investment is happening. My clients are the world's biggest sovereign wealth funds, pension funds. It's the #1 destination for investment for them. Asset prices are hitting all-time record highs. And on the other side, we have a deflationary economy, which is full of people who are unemployed and perhaps unemployable under any circumstances, where all the data points originate, which are all pretty negative. And so we have this split between the live economy that everybody wants to invest in, and most people in this room will be involved with in some way, and the economy that all the data is about. And the conflict between the two makes things very, very confusing. I think one of the biggest issues is, do we have inflation or deflation? And it's amazing. Anywhere in America, the only thing people talk about is the rising cost of living. And I recently met with a board member of the Fed who said, I live in Washington, D.C. Prices are rising like crazy, but our data and our models say it isn't. Something is wrong. And I think if even inside the Fed they think something is wrong, then maybe we can't depend on that as much as we used to.
Pippa, thank you. I'm going to ask Ross to pick up now, and then Bill after him.
Well, we do have a divergent U.S. economy. The domestic economy, final demand is buoyant. Consumption spending growing above 3%. We've had strong job gains. We're finally starting to see the wage gains commensurate with that. The housing sector is coming back. It's not anywhere near where it was prior to the housing crisis, the financial crisis. But Americans are purchasing homes again. The multifamily market has been exceptionally strong in the United States. And the non-energy investment has been strong. Now, the weakness stems from the foreign trade sector and domestic energy production, which was driving the economy forward 2 to 3 years ago with the shale oil boom. With declining prices, we've seen rotary rig counts come down significantly. Oil production has not come down much. It's started to tail off a little bit. And then, of course, the high value of the dollar, weak trading partners' economies has reduced exports, and import penetration has increased. So the domestic economy, final demand's growing at about 3.5%. You get rid of the foreign trade and the energy drag, and it's growing somewhere between 2.5% to 3%. That's my assessment.
Pretty respectable.
Yes, pretty respectable.
Bill next, and then I'll ask Adrian to give us his take.
Buoyancy. You can find certain indications of buoyancy in the economy. And we've talked about labor market gains, low energy prices, growth in household income. And then you can find other drivers in the U.S. economy, such as permit issuance, housing starts, and rising housing values, that might signal to most that there is a certain amount of real fundamental buoyancy in the underlying U.S. economy. However, if you asked me to describe in one word that economy, I'd say it's interesting. Interesting in the same sense.
That's a very political answer, I'm going to say.
That Confucius condemned his enemies by saying, may you live in interesting times. I'm an agnostic as far as the economy is concerned. My job is, with my team, to create investments which do well whether the economy rises or falls. Because there were three things that were said at dinner last night that made me sit up and take a second look. My lovely dinner companion, who's one of the leading geopoliticists for a major bank, said it's all driven by geopolitics. It's not driven by economies. Michael, who was at the table last night, said, no one I know has ever acquired great wealth betting on interest rates. Take that to heart. So my point of view is that it's interesting. There's a little bit of something for everyone in the US, depending upon what data sets you look at. And we could be optimistic or pessimistic as we choose.
Thank you, Adrian. Are you more of an optimist or more of a pessimist?
Well, I've been living and working in the US for the last 4 years, until the summer when I moved my family back to Oxford. When we left, everything looked great. And I'm afraid it's got a little bit more difficult since we've not been there. I think this point about it being an economy of contrasts is absolutely right. The consumer side of the economy has got a real shot in the arm from the fall in oil prices, and anything associated with that side of things, be it auto sales, home sales and so on, is looking pretty healthy. But the flip side is obviously the energy sector, and any industry that's dependent on the energy sector really struggling. And manufacturing, much more of a kind of mixed bag. So those sectors that are close to the US consumer, or indeed those sectors that are close to the Chinese consumer, doing pretty well. But sectors more dependent on international trade, obviously struggling with the weakness in the world economy and the strength of the dollar. I think the picture right now for the US economy is one that's pretty steady, given those contrasting trends. I think the worry is that when we think about the risks around the US economy, they're weighted on the downside.
And I think we'll want to come back to the point about China and the drag from that direction as the economic growth slows there. Oliver, would you say buoyant is right? What would you say about the state of the US economy right now?
Well, from our vantage point, we've been surprised at how resilient the economy has been. We run a non-investment grade lending business. We have credit extended out to about 500 borrowers today. 93% of those are really US-centric. Of that portfolio, as of last quarter, we saw basically stable revenue growth, slight improvements in EBITDA. But surprisingly to us, 24% of our portfolio is at or above expectation. Only 12% are below where we would expect them to be. Having said that, that is not what we're sensing from the market. We view the US consumer to be buying only one thing, and that is a new car. Everything else they seem to have put on hold, just about. Retail is weak and getting weaker. I think particular discretionary spending is very, very limited. And we see real risk in the collapse in the price of oil and other commodities, and we don't think that is correctly priced in. Now, we take a lending approach. We're in the non-investment grade world. 18% of high yield today is related to oil and gas. You throw in metals and mining, which is probably in worse shape, you're over 1/5 of the high yield market, and notwithstanding the backup in yields 2 weeks ago to about 8.5%, I'm discounting last week's rally and the continuous rally this week, we think that's a real source of concern. There are very good jobs being lost. We think it's just the beginning of good high-paying jobs being lost on the back of the collapse in this commodity price complex. And so we think that the economy looks a lot better than it should today, sort of given the headwinds.
When you talk about the only thing everybody seems to be buying right now is a new car, Ros, I know you have crunched a lot of data about what's being bought, what people are taking loans out to get.
Well, I hate to disagree, but I must. The U.S. consumer is really very strong. In fact, one of the reasons for that, if we could put up a chart, shows the household debt service burden, slide 14. So there's another chart in here that shows auto sales, and if there's been one sector that has recovered at the same rate as previous recoveries, it's been auto sales. They've already hit 18 million units at an annual rate. That's even where it was above pre-recession. Part Partly that's because people are extending loans out longer, but a lot of it is because the debt service burden has fallen significantly. Now, consumers are beginning to take on more debt again, but fortunately it's in proportion to their income growth, and interest rates are still very low. And so the household balance sheet has improved, and we're finally starting to see the consumer have the confidence, despite all the events coming from abroad from China and the stock market decline. They're willing to go out and spend income commensurate to spending it, and they're not taking on debt that would really prove to be onerous. So there are fundamental improvements, and also the labor market, despite the last couple of months sputtering a bit, only adding 160,000 on average the last 3 months, still with the unemployment rate down to 5.1%, you could argue that, yeah, a lot of that's because the labor force participation rate has fallen so much. But the consumer sector, whether you look at leisure, a whole range of services, are increasing quite rapidly.
And yet, when you come back to Pippa's point about the two Americas, there are some consumers with great confidence. There are a lot of people in jobs, but there's a stubborn section of the economy as well,
That's right.
not responding to the medicine.
Yes, and I've got even another layer of the problem, which is we're so used to assessing the U.S. economy based on its consumption capability. That was always the key to the assessment of GDP. But I fear that maybe what's happened is when people's income is compressed, or when their hope, their faith in the future has been damaged, which has certainly been a result of the global financial crisis, they lean towards spending relatively more on experiences and relatively less on things. And the experiential economy, I think, is becoming much more important. And I don't think, again, we're as good at assessing the expenditure on the experiential side, services, as we are on goods. So again, the question of how are we measuring what reality is quite important. Again, I think also this question of the rising cost of living will definitely hit the low income, the poor, much harder than those who are achieving actually record gains in their wealth. And that's back to the argument about the division between the rich and the poor having been massively widened by the steps that government has taken. And I think that also gives you two economies with two different sensations, two different visceral beliefs.
Any other thoughts on how we're measuring consumer confidence, or how optimistic we can be, Adrian?
Well, I mean, I think I would take a slightly different position with regard to issues around measurement in the US economy. I think my concern would be not that there's actually more inflation than we're recording, but actually there's probably less. That the official statistics are understating the degree of innovation that we're seeing, particularly in the digital economy, and the benefits of that to consumers and to business in general. So I think actually there's a real possibility that actual economic growth properly measured is stronger than is being recorded in the official statistics, and well-being for the population as a whole is better too. I think where there's a problem, again coming back to this point about contrast that we've all touched on, is the fact that we've got an unemployment rate that's down now at basically 5%, but a very low rate of labour participation. And I think that's one of the fundamental challenges for this economy, the contrast between the haves and haves not that Pippa has been highlighting is really about those people who dropped out of the labour market, apparently for
There was a really interesting piece in the FT yesterday, I think it was, about the very low participation rate of women in the US economy. Well, by very low, it was saying 77%, but lower than most other developed countries. And it was talking about the fact that, you don't get paid childcare in the way you would if you were here in the EU. I don't know if any of you have seen kind of a gender differential there. I don't know if that's something you've looked at, Pippa, or...
Yeah, well, and there's also this phenomena of the gig economy, which people talk about now, where you're not working full-time for one employer anymore. You have a series of gigs that you do with different kinds of employer. Very hard to measure. I think a lot of women especially are dealing with their childcare issues by working a little with this group and a little with that group, and it doesn't show up in the data as well. But it is a net contribution to growth and productivity. So it's not altogether a negative thing. I actually think it's the way we're going to go, male or female, going forward, because we're all probably going to have to work longer than we anticipated. And with medical advances, we'll want to work longer because otherwise we're bored out of our minds. So what will we do? Not one job, but series of different engagements with the economy.
Yeah, if you're a graduate now, you are looking at the gig economy, unless you're very lucky. Bill, I want us to move on to obviously one of the really big questions, interest rates, and when you think they'll start to go up, when they should go up.
Apologies to those people in the audience who were here in Los Angeles when Michael also asked me to talk about the economy, which is one of the things I know very little about. But the one thing I do know is if you lay all of the economists end to end, they never reach a conclusion.
But that's what we call healthy debate.
So let
You know, it's more
me
exciting for you.
ask the audience if I can, and
Okay,
then I'll
yes,
answer the question in my own way. How many of you think from here the U.S. economy gets better, continues to
Hands up,
improve?
show of hands.
Ooh, slow, really? Okay. How many think it gets worse from here? I would say it's
Even.
majority worse, right? You think? I don't know. It's pretty equally
I
divided.
wonder whether we should do that again in 40 minutes. And just see,
So-
you know, who won over.
So interest rates, upward. Next 12 months,
I'm going to ask you to narrow
25
it.
basis points. How's that? Very specific, right? Upward, next 12 months, 25 basis points. Who cares? It's priced into the market, my view. What does it mean for my business? What it means is that my investment margins today, because real estate, particularly in Europe where we're sitting currently, is experiencing a lot of the same dislocations that we saw in the US in 2009, 10, and 11, which means it's priced well from the standpoint of the buyer. So I can purchase good real estate, and I have about $1.2 billion with my colleagues from Moorpark, based here in London, in the last 2.5 years. We buy at between 7 and 8% yields, so feeling like 12 to 14 times multiples on income. And we're financing, depending on the market, somewhere between 2 and 4%. So I like to tell people that my business is a good business because you only need third grade math to accomplish it. But the difference between a 7% yield and a 2% financing rate is about 500 basis points. So we can all figure that out. The yield to the equity is about 12. That's a good business. Does it matter if my cost of funds goes up 25 basis points? Probably not, particularly if it's going to be a partial signal to an improvement in the economy, which for me translates to rent growth. And since I finance about 20 to 40% of my cost, my rent growth is far more important than my borrowing cost. So again, I said I'm somewhat agnostic. I've been in this business since 1974. I have always called rates incorrectly, so take my prediction with a grain of salt.
Just one thing, I think it's quite important to understand what Janet Yellen's thought process is. Fundamentally, she thinks that 2% is not the target, that we must go above the target for a period of time because we've been below it for so long. So really, they're not aiming at 2 anymore. They're aiming at a number substantially above 2. So when they say they need the inflation rate to be higher, they mean higher than 2 for a period of time. And Charlie Evans came out yesterday from Chicago and said he thinks midway through next year is a good time to do the first hike. So he just pushed back the whole timetable till June. So I think the one reason they want to go slow is they want that inflation rate to rev up. Personally, I'm not convinced that's the right solution, but it's something to think about, that that's their
Good
thought
point.
process. Go above because we've been below too long.
Oliver, do you think it might be as late as the middle of next year?
I think the Fed did just about the worst thing they could have done by their inaction. You know, we've seen what it's done to the markets. It's created significant uncertainty around the strength of the U.S. economy. I think they're desperate to raise, and yet, notwithstanding some of the earlier positive comments, they're really not in a position to raise. You know, I would certainly echo the earlier sentiments about, does it really matter? In our market, we receive LIBOR floors from about 96% of our borrowers. Those are generally struck at 100 basis points. And so until the Fed is confident enough to really raise rates continuously, If you believe in 25 basis point increments, they have a way to go. It really doesn't affect the liquidity position of our borrowers. Debt service coverage ratios are, based on low interest rates, just about as close to as high as they've ever been. And so there's really not a liquidity concern. Our concerns are much more around technicals. It's not about whether you can set up the trade correctly, whether you can finance yourself to maturity and earn what I would agree, whether you're looking at the right part of the real estate opportunity or looking at the right part of the lending opportunity to corporate America. It's really about market technicals. It's about supply and demand, and there's real nervousness in the market. A high yield market above 8% when the 10 years at 2 is not a good indicator of the general state of mind. We think the U.S. equity market has held in remarkably well, but we think the risk is to the downside. And there are significant regulatory changes from leveraged lending guidelines, curtailing bank lending to risk retention that is going to impact the formation of CLOs, which represent about 70% of all non-investment grade corporate lending. These are all significant headwinds that could take the market much, much lower, notwithstanding that the trades we're setting up are very compelling.
Can I add to that just for a moment? Because you can't truly understand the U.S. economy without understanding the consumer, because the consumer drives 2/3 to 3/4 of that economy. The consumer is, on the whole, aging. The consumer, particularly the cohort with whom we deal, is trying to match fund effectively their liabilities in retirement through yield-based products. And it's extremely difficult, particularly in the U.S., to find yield, sustainable yield. You can find it in the traded markets, but a lot of the consumers, particularly the mass affluent cohort, those who really can afford to invest to produce for their retirement, 15 million American families, $7.5 trillion of capital. That cohort is living in fear of the listed market, because the volatility in that space makes planning near-nigh impossible. And so there's a real movement, and we're seeing it not only in the endowment model, because the universities and colleges, pension funds, and insurers who have had to plan for those retirees for years institutionally got it a long time ago. And you can see that 30 to 90% of their portfolios are geared toward hard assets. You're seeing that movement slowly but certainly in the American consumer, that mass affluent investor, move from traded listed securities, stocks, bonds, and videotapes, all the way over to the hard asset realm. And that search for yield, I think, is going to be a theme, irrespective of interest rates, that really drives the U.S. consumer and in turn drives the economy.
When Oliver said inaction was the worst thing, I could hear agreement from this side. I don't know if you both think that?
Well,
or inaction adds to nerves?
Well, if you look at it, the Fed has said they were data dependent. So we've had the job growth the Fed was looking for. The unemployment rate is down to, many believe what the NARU is, the non-accelerating inflation rate of unemployment, down to 5.1%. Maybe it's a little lower, you let it go a little lower. But this is the first time, I would say, in American history that foreign developments really caused the Fed not to pull the trigger. I know many of the voting members personally, and I guarantee you there were more votes before what happened in China in August with equity markets. Keep that in perspective. Equity prices in China are where they started the year at, so
they'd gone up sharply before they came down again, for sure.
But still,
yeah.
it's the rate of change, not just the level. But many would say the Fed rightly waited. I think they missed their opportunity. We need to get off the zero bound. And what would 25 basis points do? Well, it would say that we're moving to some normal policy, whatever that might be. It's really the question of what's the terminal rate and how fast the rates go up. So my sense is the Fed probably won't move in October. And I would say December is probably the earliest, and the odds are going higher that they won't move till January, because we've had a couple of weaker employment gains in the past few months, and the Fed doesn't see anything compelling.
I think there's a danger that in delaying the rate rise, the Fed actually moved from being data dependent to being market dependent.
Right.
And have given the market a lot of influence over when rates actually move. I think the profile for interest rates going forward, it does matter an awful lot because we really need the Fed profile that they're telling us they're going to follow to be wrong, because there's such a big gap between what the dot plots are showing about the outlook for interest rates and what markets are saying. If we ended up following the Fed path, we'd be in for an awful lot of turmoil, in the US, but particularly in the emerging market world as well. I think they will be wrong, but there's a huge gap in what they're saying and what the markets are believing right now.
As Ros was referring to, one of the really interesting points about the thinking of the Fed right now is that it is obviously influenced much more by matters outside the United States economy, China, Asian markets. It worries about the drag. It worries about all sorts of spirals of instability being set off around the world, I think. Pippa, if we talk geopolitics, what's your thought about this? I mean, in a sense, interest rate rises are priced in, but they did hold back because of China.
Yeah, well, the great irony is the Chinese take the view, the U.S. has clearly told us that the way they intend to deal with the debt problem is to pursue a higher inflationary path, right? Because there are different ways you can default on your debt. You can say, I'll never pay you back, the Argentine style. You can say, I'll pay you back a little bit later less, that's the Greek. You can default on your own citizens, that's called austerity. The U.S. isn't pursuing those. It's going to do what the Chinese say we always do, and it's how we paid for the American Revolution, it's how we paid for the Civil War, and how we paid for Vietnam and the Great Society, and that is you let the inflation rate go up. So as holders of our debt, their view is this is a stupid trade, so they're selling treasuries in record numbers now, and what are they doing instead? Investing in this One Belt, One Road strategy to build out effectively special economic zones abroad, and in anticipation of a higher inflation rate in the world economy, reaching for assets more forcefully. And that is why we keep having the near misses with Chinese fighter jets and American spy planes in the South China Sea, which if you Google is a huge issue as we speak. So the Chinese view is monetary policy is relevant. It does matter. And as the last point, the movement of manufacturing from China back to the US is so severe that their view is they have lost the opportunity, the ability to pursue that be the cheapest manufacturer business model. That is gone. Now that Foxconn, who makes all our iPhones, has announced they're building a production facility in Pennsylvania because the US is competitive again. So I think this idea that China's weakness matters, they're like, wait a minute, we have a different view of we think you're not raising interest rates because you are trying to get the inflation rate up and effectively default on us. It's a different take, and it's not necessarily correct, but I think useful to think about.
And when we think about China, we've just had the grand state visit of President Xi to Washington, and of course beforehand, Seattle, Silicon Valley. Perhaps that's the bit that really mattered. Any thoughts here on how much the US should be embrace China, fear China, both, I suppose? Bill?
Well, it is a love-hate, but I think we need one another as trading partners. I think that's painfully clear. If we had been in this room 2 weeks ago, I think the majority of those who at least run their financial lives by reading the headlines would have said that we are in for a period of secular stagnation. And they would have pointed to the troubles in China and the devaluation, and they would have seen deflation everywhere until the rally last week and the continuing rally. And it's pretty hard to wind your watch around, as I say, what's next. But I think the interdependency, I mean, in my business, we're beginning to see a greater level of financial investment in the US on behalf of the institutional Chinese. The entrepreneurial Chinese have been there pretty much since the late 80s, early 90s in size. But the institutional Chinese, the insurance companies particularly, have begun to invest actively in the last 36 months. And for them, the benefit of the bargain is if they can buy bricks and mortar in New York, dollar denominated, at 3.5%, 4% yield with some upward opportunity over time, That for them is a good trade, and we're beginning to see it in size.
Oliver, your thoughts on China and how closely to embrace?
Well, I think, at the risk of stating the obvious, the U.S. economy is not an export-led economy. I mean, by contrast to many of the European countries, we just don't have the same dependence on exporting. And so we have a very, very large domestic economy that supports the vast majority of what we do. The consumer is really key, as was said earlier. So I think that this whole dynamic is challenging. I think U.S. policy with China, they're far behind the Europeans. The Europeans have done a much better job navigating those waters for much longer. And we find ourselves really in a situation where, our foreign debt is held by the Chinese, and we are very much trying to work towards inflating ourselves out of this issue. I think the U.S. dollar strength is a real issue. And I think that's something that's certainly weighing on the Fed as well. With notwithstanding the most recent moves in dollar-euro, I think overall there's a concern with all the capital flows coming into the U.S. Because we are the cleanest dirty shirt, I guess, to quote Bill Gross. We have significant capital flows, and they're continuous, and long term we think the dollar appreciates, and so there is a concern what little we do export is going to become less competitive, and I think that's a dynamic that needs to be watched very closely.
So when Britain jumps to sign up to the new Asian Investment Bank, is that something that should worry?
Well, Britain's
American
a little smaller than our
symbol,
economy.
let's say.
So no, but I thought yesterday's breakfast was fascinating. I hadn't realized a lot of the progress that was made in the last 4 years here in terms of driving innovation, and I think it was really commendable. I think reacting strongly to adversity is something that has certainly propelled many economies well ahead of where people would have expected them to be.
Well, I would say that China has listened to Western advice. In the short term, there are going to be disruptions. So what is that advice? Well, they need to be more of a consumer-led, service-led economy, less export dependent. And they're doing that. China's retail sales remain very strong. The latest trade data show imports fell, although that's in dollar terms, but volume terms not doing nearly as poorly. So China is rebalancing, but in that process, as they rebalance, it's causing disruptions throughout the commodity supply chain. Countries such as Brazil, the BRICS. So I like to say sometimes that the I is the only I left in BRICS. And that's India, of course. You look at Russia, Brazil, both in recession. So there are repercussions that stem from what's been happening in China. And it's going to take a while to work our way through that. I've been an optimist in terms of talking about reshoring of manufacturing back to the United States. But the challenge we face right now, despite becoming more competitive, the value of the dollar is appreciated quite significantly, which creates some headwinds. And I'm not sure, we might see some Chinese investment coming here for diversification here to the United States meeting. But I guess it's also important to keep in mind what Oliver said, which is that U.S. exports to China are about 7% of total exports, which represents about 1% of GDP. So you have to keep that in mind, so it's not a direct effect. I would argue the biggest effect, to close that, is it's not what happens so much in China to demand for U.S. exports, but the kind of third round effects of other emerging Asian economies that are highly dependent upon and compete against China in the markets.
And I think we may talk TPP as
Yes.
well.
And I think
Adrian.
that's critical. U.S. direct exposure to China is relatively small, but exports to emerging markets are half of U.S. total exports. Strip out Mexico, I think it's a third of exports even without Mexico. So the ripple effects that a weak Chinese trade position has on emerging markets as a whole inevitably are creating a headwind for U.S. exporters. Add on to that, effectively, a sort of competitive devaluation driven by quantitative easing in Europe and Japan that has stolen market share for their manufacturers versus American manufacturers, and that's why we're seeing so much of the manufacturing sector struggling.
I think maybe one last key point on that I think is valuable to understand. The new Asian Infrastructure Investment Bank will open with a balance sheet of $250 billion, which will make it larger than the World Bank on its first day of operation. And its intention is to build out infrastructure and the real economy side in emerging markets. So in other words, where the Chinese used to take their savings and put it into Western sovereign debt markets, treasuries, which systematically pushed down our interest rates, let us buy bigger houses and put more stuff in it, which we bought from China, which gave them more cash. That perfect circle has ended, and the new flow of capital is going to go from emerging markets into real economy activities, not paper financial sovereign debt assets.
I want to ask you all in a minute about if we're looking at a low growth economy, inside the US, where are the good investment opportunities? But I also want to give you the opportunity, if any of you want to ask any questions at this stage. Anybody who wants to put a hand up, ask a question. I don't know whether we have mics. I think you could just project and tell us your name as well, please.
Sure. I'm Tina Fordham. I'm the Chief Global Political Analyst at Citi. I was here dining with Companion last night. One thing that we haven't talked about yet is may or may not have an influence on the U.S. economic outlook is in presidential elections next year. Now, investors love to speculate about what sort of market impact there might be. Actually, there's very little evidence for any kind of sustained market impact from the change of government, and non-Americans always overestimate what the power a U.S. president has. And for us Americans, it tends to be a parlor game. And yet, we have a more polarized outlook than ever. 18 Republican candidates, Bernie Sanders giving Hillary Clinton a run for the money. Is this interesting and a diversion, but not likely to move the needle on economic policy? How much does it matter?
Good open question. Go on, Bill.
Wow.
I see you smiling.
I know.
Thank you, Tina.
I had a whole evening of that last night. Thank you, Tina. Parlor game. Probably right. When Donald Trump can actually be a legitimate contender.
I was
for
going
the
to time how long it was until we got to that name.
most
There you go.
powerful
Pretty
office in America, certainly a parlor game. My view, shortly spoken, is that it will have virtually, whether it be Hillary or one of that bevy of Republican contenders, it will have little or no interest in or incidence in the outcome.
It's like the early rounds of Strictly Come Dancing, isn't it? Where the
There's a
viewing
tweetable
public
quote.
likes the clown, and eventually it settles down, and the people with talent win. And isn't that where we are, given just the length of time to the election? We're in those early rounds where.
And could you also say that about where the money's going? Because, of course, Donald Trump doesn't need investors.
Yeah, I think that's right.
Well, if you look at where the money has gone, other than out of your own pocket, it's been going to Jeb Bush. So there's still a lot of people that think that a more traditional candidate might win out. It might not be Jeb Bush, it might be someone else, maybe a governor of Ohio, where I was born, that tends to decide presidential elections. But I think it does matter, not as much in terms of who wins the election, not probably as much as many people outside the United States think. I would argue that presidential election cycle is already having an effect. Look inside the House and what's been happening. I went down to work out at lunch last Thursday, and I know Kevin McCarthy pretty well. He's from Bakersfield, California. He's been coming to our events for years. And I had CNBC on, and he walked out and announced that he was withdrawing for running for Speaker of the House. And you have a group of 42 people that are basically deciding that their interests come before the country's interests.
And the spectre of politicians running from power.
Yes.
Because what can they do with it?
So, you look at, what John Boehner has done. He became so frustrated, he said enough is enough.
Yeah, the system is so dysfunctional that even on a good day with the wind at his or her back, I don't think our president has much influence or effect on the economy longer term. And this is a carnival.
So Wall Street's pricing in Washington.
Yeah, I have to say, having worked in the White House,
Yes.
where the expectation was we could solve everything, and in fact, you're like, can we solve anything? The White House is definitely perceived differently, as you say, from abroad. But the other thing I think is interesting is that this reflects this desire to bring in new faces, new names. It is a global phenomenon. We're seeing it here in the United Kingdom. That's why we had many more political participants in this last election than we've ever seen before. It's what we saw in Greece. When the public is feeling upset about their economic conditions, they say, these guys who've been in charge are not fixing it. Let's get somebody new. So that desire for somebody new is expressing itself in many different locations around the
You
world.
could say that in the States especially, you run as an anti-politician, you run as anti-Washington, and then you get the majority who are anti-Washington in Washington.
That's right. Well, maybe that's what makes Washington work, is that it is a kind of anti-establishment attitude. But I also think that the alliances are going to surprise people. Americans inevitably elect someone the rest of the world has never heard of 3 years before the outcome, right? Nobody ever heard of Bill Clinton. They hadn't heard of Barack Obama. And the president I worked for, George W., nobody believed that was possible. And yet, there they are,
I thought
right?
his brother was going to run.
And and I would bet it won't be Hillary, it won't be Jeb. They're already out of this race, in my judgment. What will matter now are algorithms will decide this election for more than any time before, and alliances. So
What
it
do you mean about
matters.
algorithms? Do you mean
Well,
keep reading Nate Silver or
I
what?
just definitely keep reading Nate Silver. In other words, algorithms, that the way the public responds, the way the news responds, are going to be driven much more by what are people clicking on than by actual votes in a voting booth. In other words, people's opinions are being formed much more heavily by their interrelationship with the internet. And so that's why the Donald Trump phenomena is actually quite important. I mean, it is the best reality TV anybody has ever seen. And the public is watching this and engaging, and that's increasing his popularity. So it's an iterative process. And I don't think we should underestimate that. And who is the one Republican that he has not criticized and that he's really tight with? Ted Cruz. And I think we should watch that possible alliance, which will surprise people. And similarly, Joe Biden, if he steps in, watch his discussions with people like Elizabeth Warren. And I think we're going to end up with a very interesting race. Maybe I'd only disagree with you on saying the spread between the two sides may be wider than people are expecting.
Wow. Oliver, parlor game, does it matter? And if you want to, place your bet right now, we're listening.
I'm not in the betting business, but it does seem a lot like Big Brother, a nice Dutch export to the United States.
Hillary Clinton. Is anyone else pricing Hillary Clinton out? Does they think Hillary Clinton's not going to get the nomination or not the presidency?
I think that she's not even going to get the nomination. I think if Joe Biden steps in,
Right.
which he is on the brink of, the unions have already jumped to him, and I think the email scandal and a few other things will give her a gracious reason for getting out.
Because the Americans have had decades to warm to her, and they haven't.
Well, I think, if you ask why, my answer would be the American public has not been happy on the left or the right with her kind of very imperious, I've already measured the curtains and I don't know why we should have to go through this election process attitude, more than anything. Rather than policy, rather than substance, and that's a danger, which
We got to the point of saying that the politics, the presidential race won't influence very much the real economy, but actually something that Joe Biden, predicates his appeal on is, I understand the working American. I get that background. I get blue collar. And Hillary Clinton is now starting to talk much more about getting that, and maybe thinking of, say, the swing Ohio voter. But a lot more. I don't know whether it's just always the talk you get in elections where they vie to say, I get the common man or woman, or whether it's about a greater shift and people worrying more about inequality. I don't know whether
Well,
what you
I
think.
would have
Ross.
to say there is rising concerns over inequality. There's no question that's there. Of course, this is in the primaries, you get more focus on this, and then you get to the general election. But I think things are a bit different. If you look at consumer confidence measures, and you look at it by income quartile, you see the widest divergence between the upper quartile, even the second quartile, and the bottom two. They're much more pessimistic. It's largely a combination of kind of low educational attainment, blue-collar jobs that have been globalized away, feelings of insecurity. And so politicians are trying to address that. The Republicans would say the answer is more entrepreneurship, That's where job creation comes from, and they're correct. You need to reduce regulation, so that's the Ted Cruz and that story. And on the left, it would be you need to have more social capital, more retraining. Many Republicans would agree with that. So there's not a disagreement that there is inequality and it's widened. The disagreement is over how best to address it. And that's, I think, the battle we're going to have during this political season.
There was the question at the back. Thank you. Tell us your name.
Anastasios Economou.
Oh, there is actually a mic.
Can you hear me now? Super.
Yeah.
Anastasios Economou from my group. When we're talking about interest rates, and I understand the difficulty of timing and predicting them, but I would like the opinion of the panel in terms of whether the Fed will go like they did in the past, meaning when they start raising, they continue raising. Because the fear in the market is not so much the 25 basis points, but that if they follow the past, once they start, they'll go very quickly to 2%. And that is why there's concern. If the panel feels that it's just going to be 25 and they can wait, then that completely changes the view. Thank you.
Thank you.
Yeah, well, I mean, I think that the likelihood is that, you know, as rates rise, yeah, it won't just end up being one. It will be some, but it's likely to not be all the way up to 2 quickly. It's going to be a very slow profile through which interest rates rise. You know, given that, you know, the headwinds that the economy is facing, you know, low interest rates are going to be necessary just to keep growth at something the Fed's going to feel is respectable, around 2.5% or so. So slow and very drawn out. I think.
I think the Fed will be much more reflective. The past is not a prologue to the future in terms of, in the past, once they've started rising, it's almost on a glide path. Now I think the Fed, as you look at why they delayed an increase in September, they're looking at not only domestic activity, but also how international events are affecting things in the U.S. I think they'll go 25 basis points. They'll wait and watch, and then if they feel that the U.S. economy has survived it and continues to grow, then they'll move again. So I think, I mean, if you look at the dot plot, you think the terminal rate, you know, is 3.5%. I don't see how that happens. You could argue that the terminal rate might be somewhere around 2.25. That'd be my sense.
For me, the key is that Janet Yellen takes the view that whatever hike they do, it's not a hike. We're so far below whatever the break even is, it's just a normalization of absurdly low levels of liquidity, right? And I think they're going to sell it that way. This is not a hike that's intended to slow economic activity. It's a normalization from an emergency level liquidity situation back to something that is more in the known arena, which provides the opportunity for rate cuts as well as hikes at a later date. In other words, it's all about taking back their optionality on this issue. So I do not think they intend to signal in any way that we are heading upward on a known path. It's just about restoring some sense of control, because as long as you're at zero or threatening to go negative, then you have no control. By the way, the fact that the board is divided even further apart, as of this last statement, we had one, Jeff Lacker, who said, I dissent, we should raise. And we had one unknown who said the projection in their view is for negative interest rates. So in other words, the spread is widening, which means the conviction behind any action is less.
I would agree. For the
Minneapolis Fed.
Fed to take the power back, they need to build a fulcrum. That fulcrum needs to be something off of zero naturally. Our view, and in our models, we're looking at the Treasury, the 10-year, which is where we price off of, to move from about 2% to about 3% over the next 24 months. So that clearly implies, though I have a short-term view of 25 basis points, that the longer-term view is about 100, right or wrong. I would point out, though, most importantly, kind of getting back to my common theme, that if you take a look at the U.S. since '79, there have been 7 Treasury rate hikes of significance, 100 basis points or more. And real estate in that environment, off of the traded space, so real estate in the private sector, has run up on average during that rate rise of about 15% per annum. In fact, through consistent rate hikes, real estate tends to outperform about 85% of the time, because those hikes typically signal in part economic improvement, which translates to rent, which translates on eventual occasion to inflation, higher replacement costs, all of which are, again, buoyant for that type of investment.
I am going to ask you in our last few minutes to give our audience some insight or advice about where are the really exciting sectors right now, maybe investment opportunities. I did see another hand go up though. Tell us your name.
Tina Raja, Genport Capital. My question is about exogenous factors. We touched on China, and obviously at the last FMC meeting there was discussion of external macro backdrop, etc. My question would be, in the lead up to December FOMC and obviously the much anticipated hike or no hike, what in your view is the biggest exogenous headwind that the US faces?
I like that phrase. I might have to try and use it on air. Exogenous headwind. Yes. Pippa?
You want me to start? Well, I go back to Tina Ford's point. It's geopolitics. And there's so many different fronts. We are literally seeing, I mentioned before, this business of American spy planes and Chinese fighter jets getting within 30 feet of each other. There's a reason Washington and Beijing have recently installed a hotline. It's because everybody guesses they might actually come within a coat of paint at some stage. That will be disruptive to markets. I think it can be resolved. Nobody wants it to escalate, but it'll be noisy. Russia is being relatively aggressive on multiple fronts. It's not just about Ukraine or Syria, where there's a lot of noise in the Arctic, all the way to the Mediterranean, Black Sea. That's an all-front situation. And we've already heard the head of the ECB, Mario Draghi, say, geopolitics is the one risk that I can't really manage. I think we're going to hear the Federal Reserve say the same thing. So geopolitics becomes both the big risk and the thing you hold in your back pocket if you need yet another excuse not to act. It's useful either way.
I would go domestic exogenous shock, because I think we're kind of discounting the fact that the U.S. doesn't have a budget. The debt ceiling needs to be increased. And we have a non-elected future Speaker of the House. And so we've got until early December, and it's really a game of Russian roulette. That's honestly where we're at today. And inside the House, and you have the members of the Freedom Caucus or Coalition, whatever they call themselves this day, who are willing to hold the government hostage. And it makes it difficult for someone who wants to govern, because if they want to get elected speaker, they have to be cognizant of what this small faction in their own party thinks. So, you could see brinkmanship. Ted Cruz is going to be egging them on from the Senate side, not to give in, to get something back in terms of raising the debt ceiling. So I see that as a real risk. Something could go wrong. Is the government shut down for a week or two? Certainly possible.
If I was going to pick a wild card, I think it would be a lurch down in oil prices. Something that meant that headline inflation got even further away from target. Would create a context in which it would be quite difficult to explain interest rates going up.
Any other thoughts about wild cards?
Yes, I have a thought. I had dinner 2 nights ago with a gentleman who was a retired senior officer in the U.S. government in charge with security. And for 12 years, he functioned on the inside of the Beltway, and his job was to, simply put, protect America at the most senior level. And we asked him over the course of the dinner what he thought the likelihood was of a significant attack on U.S. soil by a terrorist group next 12 months. Do you want to guess? I would have been way off. He said 85%. That, I think, is the most significant exogenous headwind that we face.
Wow. And we got to the last few
Well,
minutes
not
without
optimistic,
talking
no.
security. I know, we will try to bring you just a brief, hint of optimism from each of our panelists before we go. You have a question?
It's not very optimistic, but a recession word.
Oh boy, you go.
So, capital markets famously forecast 9 out of the last 5 recessions, and economic forecasters none of the last 5 recessions. This economic expansion is pretty long in the tooth. The Fed dot plot just sees it going on for years to come. I'd like you to say which calendar year do you forecast the US economy is back in recession?
A forecast for recession.
Law of averages, 36 months after the first rate increase, you move into recession. So 3 years, 2019.
We'll put that into a political cycle. Would you like to make a bet, Ross? As your
Yeah, I'll have to make a bet. I would probably have to agree with about 2019. Now, that would make this a very long expansion, right? But of course, one of the benefits of having a weak recovery is we don't have the pressures that haven't built up that normally do. So expansions don't just kind of die on their own. We also, we've always had an inverted yield curve prior to going into recession. I don't see that unless the Fed gets way too out in front of everybody else. But I would say it's still a ways off.
I think there are two factors that have typically triggered recessions. One is monetary policy tightening because of inflationary pressures, and the second is some kind of financial crisis. And it's the second that actually worries me.
Yeah.
You know, as interest rates start to move, what might we uncover? And that might be the source of the recession. That might be sooner than 2019.
Good.
Oliver, I think I'm going to try to ask you to start by lightening what we've got here and talking about opportunities. If you're looking at opportunities, giving us insight into something maybe we haven't really focused on, where would
Well,
you
if
go?
the panel's right about calling the next recession, this is an unbelievable time to be long U.S. credit. So hopefully, fingers crossed, we are in fact that far out. I mean, default rates have been hovering near all-time lows. You know, there's a lot of liquidity in the market, and there's a tremendous excess spread to be earned over effectively the implied credit cost to many a U.S. borrower. So, you know, even with perhaps a less optimistic view of when this economy may turn, we think credit is very attractively priced. There's a tremendous opportunity in the U.S. today to invest in $1 trillion floating rate senior secured loan market, the biggest in the world, that offers attractive spreads, original purchase discounts, call protection, and these LIBOR floors I mentioned earlier, which if the Fed does not get to move the way that I think everyone on the panel believes in the short term, have real value. So the trade we like is the non-investment grade U.S. corporate loan trade. We like it match financed. We can secure 10 to 12 year financing on an asset that has an expected life of 3 to 4 years. This worked really well the last time around. CLOs are probably the best performing asset class no one thought would do so well. You know, mid-20s cash on cash returns for funds that were launched in the summer of 2007. Probably not exactly what people thought, certainly not by the end of 2008. But we think there's a great credit trade here. Broadly diversified, 150, 200 unique borrowers, diversification across industries, preferably no oil and gas, no metals and mining. We don't think you need to go there to earn a respectable return. And again, I mean, with a recession in 19, that'd be awesome, but we'll take one in 17 and still do well.
Yeah, I have to say, I'm on the optimistic side as well. Markets have a way of doing whatever is most painful for the majority of the participants in the market. And I asked myself, what would be more painful? Having assets melt down or having asset prices melt up? And as I look across the landscape and I see if I make a plain vanilla loan to a U.S. manufacturer right now, I can have that 3 times collateralized, and that is paying me within 1 year something like 12 to 15%. I'm like, that is a great trade. So I think the real economy is producing real returns. You know, the graduates of the Colorado School of Engineers and other engineering mining companies are getting paid more than Harvard Business School graduates because we've got shortages of engineers, and the real economy activities still matter. So I come down with, okay, if the Fed is basically telling us they're going to do whatever is necessary to get the inflation rate up, I don't want to be in bonds. I want to instead invest on the equity side, and I want to look for all this entrepreneurial initiative. And I mean, to that end, I personally decided to build a company that creates drones, a real economy company in the high-tech space. I mean, a person who normally one would think is only in financial assets. I'm like, go with the real economy. That's where the action is going to be, which means it's not in the aggregate data. And by the time the aggregate data confirms what I'm saying, it will be too late to invest in any of this.
And if you're talking real economy and you're talking about entrepreneurial activity, then your hope at least has to be that one of your Americas pulls the other up.
Exactly.
Bill. Oh, there we are. I wasn't looking at the end. Thank you very much. I think we've got recession predicted. We've gone through politics and dismissed it largely. But a lot of insight there into the way the US economy is and the way it likely will be. Thank you all very much.